Stop. Don't file taxes till you watch this costly IRS Mistakes 2026. Stop. Before you file your taxes in 2026, you need to understand this, because one small mistake can cost you thousands or trigger an IRS audit. Write your filing status in the comments: single, married, head of household, and I'll help guide you. Now let's begin. 1. Who must file in April 2026? Before anything else, you need to know this. The official deadline to file your 2025 federal income tax return is April 15, 2026. And yes, not everyone is exempt. You are required to file if you are a U.S. citizen or resident and your gross income exceeds certain thresholds, approximately $15,750 for single filers or $31,500 for married filing jointly. You are self-employed and your net income is $400 or more. You are a non-resident with U.S. source income on must file Form 1040-NR, or you are a dependent and your unearned income, such as interest or dividends, exceeds specific limits. 2. What must you report? Key concepts. In the United States, the system is clear and uncompromising. You must report your global income. That means everything, no matter where it comes from. This includes wages and salaries from traditional employment, self-employment income, including freelance work and the gig economy, investment income, interest, dividends, and capital gains, including cryptocurrency and digital assets, other income, prizes, gambling winnings, retirement pensions, and in some cases, tips, which now may fall under new exemptions introduced in recent 2025 to 2026 legislation. 3. How do you file? The process. When it comes to filing your taxes, you have 3 paths, and choosing the right one matters. 1. E-file, electronic filing. This is the method recommended by the IRS. It is faster, more accurate, and you can do it yourself. 2. Professional preparation. You may choose to work with a CPA, certified public accountant, or an enrolled agent for expert guidance. 3. Mail filing. You can still send physical forms by mail, although the IRS is gradually phasing out paper checks in favor of direct deposit. 4. Main forms and how to fill them out. Now we enter the core of your tax return. Understanding the forms is understanding the system. Form 104. The foundation. This is the primary form, the backbone of your entire tax filing. It is divided into critical sections: filing status, single, married filing, jointly, married filing separately, or head of household, income, the total amount reported from your W-2 and 1099 forms, deductions. You subtract either the standard deduction or your itemized expenses, such as medical costs, state taxes, and more, to determine your taxable income. And here is where many people make costly mistakes. One of the most misunderstood concepts in the entire system: head of household. This status offers one of the most attractive standard deductions, $23,625 in 2026. But it is also one of the most misused. Why? Because people confuse the social idea of being a provider with the legal definition used by the IRS. And in taxes, the law is the only thing that matters. 4.1. The golden rule: married versus single. This is where clarity becomes power. For the IRS, the rule is simple and absolute. If you are legally married as of December 31st, you generally cannot file as head of household, even if only one spouse works, even if one provides everything. The IRS does not see individuals, it sees a legal unit. So if you are married, you must choose. Married filing, jointly, married filing separately, and in most cases, especially when one spouse works and the other does not. The most beneficial option is married filing jointly because it gives you the highest standard deduction available, $31,500 or 4.2 when his head of household actually used. The status was not designed for married couples. It was designed for those who carry the weight of a household alone. To qualify, you must meet all of the following. 1. You must be single or considered unmarried as of the last day of the year, December 31st. 2. You must pay more than 50% of household expenses. This includes rent or mortgage, food, utilities, and repairs. 3. You must have a qualifying child or relative who lived with you for more than half the year, at least 6 months and 1 day. 4.3 Does gender matter? Absolutely not. The IRS does not care if you are the man or the woman. It cares about facts. It cares about numbers. It cares about compliance. A single mother supporting her children, she qualifies as head of household. A divorced father with custody, maintaining the home, he qualifies as head of household. In taxes, the law does not see gender. It sees responsibility. 4.4 The exception for married individuals, separation rule. Now here's where things get more technical. There is a specific exception, but only under strict conditions. A married person may qualify as head of household if their spouse did not live in the home during the last 6 months of the year. They paid more than 50% of household expenses. The home was the main residence of a dependent child in reality. Most people get wrong. Many people believe if the husband works and the wife stays home with the kids, then he is the head of household. But that is not how the IRS defines it. If you are legally married, the IRS sees you as a team, a joint financial unit, and the head of household status is a special benefit reserved for those who truly maintain a household on their own with dependents. Do you see the difference? This is not just a misunderstanding. It's a terminology error that can cost you money because on the form 1040, if a legal marriage exists, the correct path is married filing jointly. Supporting forms received from employers or payers. Before you file, you must understand the documents that build your return, because every number you report comes from somewhere. These are the most important forms you will receive. W-2. This is your wage and tax statement, used for employees. It shows exactly what you earned and what was withheld. 1099-N. You see non-employee compensation, used for independent contractors and freelance income. 1099-K. Third party. Network transactions used for payments received through platforms like PayPal, Venmo, or credit cards. 1099-D. Digital assets. A newer form used to report cryptocurrency and digital asset gains. Most common schedules. Now we go deeper. These schedules expand your tax return and reveal the full picture of your income. Schedule C, used to report profit or loss from a business. Schedule SE, used to calculate self-employment tax, including Social Security and Medicare. Schedule 1A, new in 2026, used to claim new deductions, such as auto loan interest or non-taxable tips. 5. Filing tips, technical perspective. Now we move into precision, because in taxes, details are everything, and one small error can invalidate your entire return. SN or ITIN, critical identification. Your social security number, SSN, or individual taxpayer identification number, ITIN, must be 100% correct. One mistake here, and your return may be rejected. AGI, the foundation of your taxes. Your first step is calculating your adjusted gross income, AGI. This number is not just important, it is the foundation of almost every tax credit you may claim. Direct deposit. Speed matters. If you want your refund fast, this step is essential. You must provide your routing number, your bank account number. Do it correctly, and you can receive your refund in days instead of months. Electronic signature, identity verification. In the United States, the system works differently. It does not rely on complex digital files. It relies on data verification. To submit your return electronically, you must prove that you are who you claim to be, and this is done through an identity protection pin, IP pin, or your prior year tax return information, and the system behind the process. The U.S. tax system is built on one principle: verification, not assumption, not estimation, verification. Every number you submit is cross-checked. Every form you receive is already in the IRS database. And that means one thing: if something doesn't match, the system will catch it. Electronic signature, how the IRS verifies your identity. When the IRS talks about an electronic signature for Form 1040, it's not just a formality. It's the method used to digitally sign your return and prove that you are exactly who you claim to be. And to do that, you have two primary paths. 1. Prior year AGI, the standard method. For the IRS to accept your April 2026 tax return, your software will ask for one critical number: your adjusted gross income, AGI, from your 2025 filed return. Why? Because, in theory, only you and the IRS know that exact number. It is located on line 11 of last year's Form 1040. And here's where precision becomes everything. If that number does not match exactly, down to the last cent, your return is instantly rejected for what the system calls a signature error. 2. IPPIN, identity protection, PIN. Now we step into a higher level of security. The IP PIN is a 6-digit code issued directly by the IRS, and it changes everything. It is assigned to individuals who have been victims of identity theft, or to any taxpayer who chooses to request it voluntarily for extra protection. Each year, a new code is generated. And if you have an IP PIN, your prior year AGI no longer matters. The system will only ask for this 6-digit code, and without it, it is impossible to submit your return electronically. Explained, simply like a bank. Let's break it down in the simplest way possible. Your AGI is like your secret security question. How much did you earn last year? Your IP PIN is like a verification code sent to your phone to authorize a transaction. 2 layers of identity. 2 ways to prove it's really you. First-time filers. Important. If this is your first time filing in the United States and you do not have a prior year AGI, do not panic. Simply enter 00 in the prior year AGI field. The system will recognize you as a new taxpayer and validate your signature accordingly. The reality of the system. The U.S. tax system is not flexible. It is precise, it is strict, and it is built on data matching. Every W-2, every 1099, every transaction. What companies report, the IRS already knows. This is not just about filing taxes. This is about doing it right, avoiding penalties, and staying one step ahead. Let's look at a real-world example. Imagine a single filer with $60,000 of taxable income in 2025. Most people think they'll owe 22% on the full amount, but that's not how the IRS works. Because of our progressive tax system, your first $12,000 are taxed at only 10%. The next chunk is taxed at 12%, and only the remaining portion reaches the 22% bracket. In the end, your effective tax rate is much lower than you think. Technical breakdown. Tax calculation. If the taxable income is $60,000, the IRS divides that money into 3 buckets or brackets. 10% bracket, the first $11,925 arrow, tax $1,192.50, 12%. Bracket from $11,926 to $48,475, meaning $36,550 of that income. Tax $4,386.00, 22%. Bracket, the remaining amount over $48,475 up to $60,000, meaning $11,525 of that income. Tax, $2,535.50. Total tax liability, $8,114. Effective tax rate, 13.5%. The epic fact: even though you are technically in the 22% tax bracket, your actual out-of-pocket cost is only 13.5%. This is the power of the progressive tax system. But wait, it gets better. This is just the starting point. In my upcoming videos, I'll show you how different scenarios and strategic tax credits can slash this bill even further, sometimes even resulting in a massive IRS tax refund. Stick around because you don't want to miss how the pros actually play the game. If this helped you see things differently, don't keep it to yourself. Like this video, share it with someone who needs to see this, because one mistake can cost thousands. And if you want to truly understand how to fill out your tax forms step by step, make sure you subscribe and watch the next videos on this channel, because this is just the beginning. I'll see you in the next video.